Hello, everyone. Welcome to the Inventors Roundtable East, although we've got people invited from all over the country to join us tonight to learn more about the R&D tax credit. The first time I heard about it, I thought it was a scam. And then, nope, I went to the IRS website and holy cow, it's been around for 40 years. So we are trying to help all of our inventors know when they can take advantage of it. Advantage, when you're talking about the IRS, might not be a good word, but when you can learn how to use it to benefit you and the income from your invention. So we have got two speakers with us tonight from Claris R&D, and they are our experts. And ladies, we're going to let you go ahead and present. Monica, are you going to be presenting?
Yes, I am. I'll go ahead and share my screen here so you can see our slide deck.
There you go. There you go. All right. Once you guys are done, then when you guys have got questions and stuff, just let us know so that we can make sure that you're on the right track. Please take a couple of minutes to introduce yourselves so that we know who's doing the talking.
Great. Well, I'll go ahead and get us started. Here. All right. So just to get us started, my name is Monica Deal. I'm the VP of Tax and Operations for Arvo Claris R&D, and Sybil Bailey is joining me today. She's our partner account executive. In our roles, we're both focused on helping businesses to understand and claim the research credit. And we're excited to share some information about the credit with you today. So we hope this will be a good learning experience for all of you, get some good information that will be helpful to your businesses. So I've got a little agenda kind of up on the next slide here, but really our goal is we want to make sure that you walk away with an understanding of what the R&D tax credit is, how you can determine if your business qualifies for it, how to determine how much it might be worth to your business, and then how to, of course, capture this valuable incentive. I think when most people who are in a career path maybe a little different from mine hear somebody start talking about taxes, their eyes kind of glaze over and their mind understandably goes somewhere else. But I'm hoping to keep your attention for a little bit of time today, because we're going to be talking about a credit that gets money back to businesses. Most importantly, there are many businesses that qualify for this credit who are missing out because they don't realize that this is for them, or they just feel like the process of creating some documentation about what they did and actually calculating and claiming the credit might be a little too painful, but we can definitely help you with that. Let's see if we can break some of this down for you today so that you understand how the credit works and so that you're not missing out on an incentive that maybe your business has already earned and there's money kind of literally sitting on the table for you. What we like to do is we'll definitely have some time at the end of the presentation for some Q&A. So if you have questions along the way, feel free to jot them down, shoot them into the chat. But I will definitely leave some time at the end so that we can try and answer those questions for you. Okay, so let's talk about who we are. Arvo Claris R&D is a software and service provider for the R&D tax credit. Our business was founded back in 2016, and that was when there was a change in the R&D tax credit tax code. That was when the PATH Act went into place. And what it did is it provided an opportunity for early stage companies to begin taking the credit against payroll taxes. Given the size of those businesses, they were likely to be claiming smaller credits with fewer resources. And so Claris R&D developed software to accompany our service offering, which allowed for the credit to be claimed more efficiently and therefore more affordably. Our secure platform creates a streamlined and repeatable approach to what can otherwise feel like an overwhelming process, a little bit tedious and cumbersome due to IRS guidelines and requirements. We strongly believe in offering a service component alongside our product because the tax code, while it's explicit, has changed somewhat over the last 40 years, as you can imagine, since this credit was introduced. And the type of technology being created today is drastically different than what they could have imagined back in the 80s when this was originally written into the law. Our team of tax experts and CPAs ensures that R&D studies bridge the gap between the latest technology development and the requirements in the tax code. When we began, like any new business, we weren't sure how the market would adopt this hybrid software and service approach, but to date, we've served over 1,800 clients and identified $370 million in tax credits. So this can be a valuable incentive, and that's why we're so anxious, Sybil and I are always so anxious to talk about this and share this information with businesses. Okay, so let's talk a little bit about what the R&D tax credit is and how it's changed. Let's just talk about it at a high level. The R&D credit was created in the 1980s, and the whole idea was to encourage innovation and economic growth in the US. We were looking for businesses to invest in developing new products, developing technology in the US. This is a credit that's aimed at encouraging development of new products, and this is, of course, something that sounds like your team is doing every day. Innovation is expensive. I'm sure you have all experienced that to some extent. And so the government created a tax incentive, some kind of a tax break to offset some of those costs for businesses. This is what you would refer to as a general business credit. That's a category of a specific type of income tax credits. And general business credits have a 20-year carryover period. So I know that in talking a little bit before we got started, it's my understanding that a lot of your businesses don't have actual employees that might benefit from that payroll credit, but that you might benefit from an income tax credit. And the important thing to think about is that the income tax credit does have a 20-year carryover period. So when you go and you claim that R&D tax credit, if you don't have enough tax liability in the year that it's claimed to use up your full credit amount, the balance of that credit carries forward. You can use it in future years against those liabilities. So be thinking about that. This is something that's valuable and can stay with your business for a period of time to still kind of offset some taxes. That income tax liability the income tax credit is how the R&D credit was initially set up to be a benefit against income taxes, which was great for companies that had the income tax liabilities. The PATH Act, what that did is it really gave an opportunity for startup companies to be able to monetize their credits. So where we have a company in their early stages, kind of just getting started, they're spending more money than they're taking in. They are not yet profitable and don't have any income tax liability yet. This puts them in a position where they were kind of missing out. They were doing exactly the type of work that the credit was designed to encourage, but they didn't have a tax liability to use that credit against. But with the PATH Act in 2015 that was passed, this made the R&D tax credit, first of all, a permanent part of the tax code. It used to be one of those benefits that had to be renewed every year through a tax extenders package. And then it also introduced the payroll tax offset. And so where startup companies meet the requirements of a qualifying small business as defined in the tax code, and we'll get into those details later, they're eligible to use their R&D tax credit to offset their employer's portion of FICA tax. So while they may not have any income tax liability, if they had employees, they're paying payroll taxes, and they could use this credit to offset those. So we'll get a little bit deeper into the last couple of bullets on this slide in a few minutes, but there have been two more recent changes that have impacted the R&D tax credit and R&D in general. First of all, the Tax Cuts and Jobs Act impacted the way in which businesses amortize their R&D expenses. And that's thinking about whether you fully deduct those expenses in your tax return versus being required to spread them out over a period of time, over a number of years. And then second, the Inflation Reduction Act doubled the payroll credit. It increased the maximum limit to $500,000. So there's now a $500,000 cap on the credit that can be claimed against payroll tax. And it also allows businesses to use the credit against both the Medicare and Social Security portions of their tax liability. Previously, that was only available to offset Social Security taxes. So along with federal research and development tax credits, many states offer R&D tax credits. It's probably about 2/3 of states, you can see from this map, that offer some kind of an R&D incentive at the state level. So this map kind of gives you an idea. It's probably about 2/3 of states that will offer some kind of a benefit. Now, one thing, if you get into state taxes, if you've looked at state taxes very much, you'll notice that state by state, they all like to create their own rules. So most of these credits kind of follow along with the federal rules, like the same type of eligibility requirements and things like that. But how they're calculated, historical information that you might need to calculate the credit, how they're going to apply it against tax liabilities might vary from state to state, and it actually does pretty significantly. But this is something that we tackle as a part of our standard R&D studies. We're going to calculate and do the documentation for your federal credit, as well as look at state opportunities for your business. So that kind of gives you the opportunity to claim a credit, not only at the federal level, but the state level too. Now, these are situations where we'd always want to kind of loop in your your CPA or your tax preparer for your business, just to verify things. There are situations where businesses don't have a state tax liability. And so we want to make sure we're looking at those things and considering, how much you'd be able to utilize those credits going forward before we got too far into calculating those benefits for you. Okay. So let's look a little bit more at the recent changes, some of these recent changes. So let's start with the Tax Cuts and Jobs Act. This didn't impact the R&D credit directly, but what it did impact is Section 174. And Section 174 of the tax code is the part of the tax code that tells us how the costs that you pay related to research and experimentation work are allowed to be deducted on your tax return. For tax years beginning prior to January 1st, 2022, these costs were fully deductible on your tax return in the year that you paid them, or they could be amortized over 5 years, kind of spread out a percentage of that spend over a 5-year period you could take as a deduction. And what happened is the Tax Cuts and Jobs Act took away the option to deduct the costs in full in the year paid. And so that had a big impact on a lot of businesses, especially small businesses. Costs that are eligible for the R&D credit are outlined in Section 41 of the tax code, a different part of the tax code. And those costs are actually a subset of the research and experimentation costs that we talk about in Section 174 and the costs that were impacted by this change in the law. The overlap between the types of costs described in each section has caused some confusion, not only around taxpayers, but also around some tax professionals. What ended up happening is the change resulted in businesses being allowed to deduct only 10% of their total R&D spend in the first year. And then the balance of that other 90% is kind of spread out over subsequent years and then deducted at those time periods. And so now if we think about the impact of those changes, what happened was that it impacted the deductibility of the 174 costs. And this has been an important topic since 2023 when that change first went into effect. The lower deductions, so let's just think about very high level on your tax return. You're all probably familiar with this, but I'll run through it anyway. When you're looking at your tax return, you're looking at your total income, you have some deductions, and then whatever's left over at the bottom there is what you're paying your taxes on. If one of those deductions was pretty big and it just got a lot smaller, your taxable income just went up. And so you're paying more tax liabilities. And that's been a pretty tough position for some businesses to be in. What that does is it eats up things like net operating losses or tax credits, other tax benefits that a business might have a little bit more quickly. In our opinion, that makes these credits a little bit more valuable because the more of those you have, it helps to offset some of that increased liability. And the good news from the credit side is that nothing has really changed with the tax credit itself or how it's used or how it's calculated. There is a limitation on how you can deduct those costs in the first year. There is no limitation on the amount of those costs that you can include in your R&D credit calculation. So everything that you spent during the year that falls into the category of those R&D expenses eligible for the credit can go into that credit calculation. And that allows you to claim a little bit larger credit. Now, one thing to think about with these changes is that businesses are required to amortize those costs regardless of whether they claim an R&D credit. This was something that was reinforced because there was a lot of confusion about this. It was reinforced in IRS Notice 2023-63, and that provided some guidance on the amortization of costs under Section 174. Some of you may have heard some discussion about the research and development expensing and reinstating the immediate expensing. There has been proposed legislation that has come out even since the Tax Cuts and Jobs Act was initially passed back in 2018. There have been several bills, bipartisan bills, proposed to eliminate or push back some of those changes and to allow businesses to fully deduct those expenses, but nothing has been signed into law at this point. However, because there are provisions of the Tax Cuts and Jobs Act that are set to expire soon, even later this year, we anticipate that the federal government will pass tax legislation this year. It is expected that one component of that, there's going to be a lot of things, it's going to be a large tax package, as I understand it, but one of the things that is expected to be in there is restoring the immediate expensing of this 174 costs. We have stayed in touch, individuals within our business who work with lobbyists in Washington. Every time I'm on an educational webinar and I can ask a question of somebody working in Washington, we keep asking about this issue because it's of particular interest to our clients. And it's pretty widely believed that that immediate expensing is going to go back into place as a part of this package. Nothing is set in stone, of course. It's not a done deal until the tax bill is actually signed. And the other question that we have, while we feel like that is going to happen, we don't know what time period that's going to go against. We don't know if it'll be retroactively to years before 2025, or if it'll be kind of more on a go-forward basis. I think that's probably more likely starting with the 2025 or 2026 tax year. So that's one of the questions that we will still have outstanding. Hopefully, within the next few months, they'll start doing some work on that tax package. I think this is something that is widely understood. That wants that people really want to have done to restore that immediate expensing. So it's likely that's going to happen. Hopefully, that'll be one of the earlier pieces that they'll at least have drafted, so we can get an idea of what the government's thinking as it relates to this piece. Okay, and then the other piece of legislation we talked about was the Inflation Reduction Act, passed a couple years back in August of 2022. What that did as it relates to the R&D credit is it expanded that payroll credit for the early stage companies, those startup companies, for tax years beginning after December 31st, 2022. The $250,000 cap on the payroll credit that had been in place since 2016 was increased to $500,000, so it was doubled. And then that credit was previously eligible to be used only against the employer's portion of Social Security tax, and it is now eligible, or since the year starting after December 2022, it's eligible to be used against both the employer's portion of Social Security tax and the employer's portion of Medicare taxes. So kind of giving businesses the ability to use those credits and offset more of their expenses. Okay. So let's think about, I think one thing that Sybil and I start with, and it is a big part of the work that we do, is just trying to promote, like we're doing today, trying to promote some understanding of the R&D tax credit. We find that this is a benefit that is available to businesses every single year. If your business is doing this type of work, if you are developing new products, if you are improving products, you're going through an R&D process in the US, and we'll get into the specifics on qualifying here soon. But if you are taking on those types of activities and spending money each year, you are likely eligible for this credit. And this is a widely underutilized credit. The reasons that it's underutilized are just a lack of awareness in one area. I mean, I think that's probably the biggest factor, is that businesses aren't aware that the R&D credit is there. They don't know about it. The accountant or tax preparer that they're working with may have heard of it, but may not be super familiar with it and how you qualify and how it's calculated. You may not know that even if you claim the credit, an income tax credit, well, I don't have an income tax liability yet. Well, we generally use as a rule of thumb about 5 years. If you're going to start paying taxes in the next 5 years, it might make sense to start accumulating those credits. You have them available to you for 20 years to be able to use them. And that's something that people are not aware of. And then, of course, startup companies having the ability to monetize those credits right away against payroll taxes where they're eligible. And these are some key reasons that the credit is often missed. For companies that have heard of the credit, they might be in a situation where they just assume that they're not eligible for it. For a long time, the R&D credit was kind of out of reach for smaller businesses. The ones that really benefited from the R&D credit were companies like IBM, GE, Procter & Gamble, large manufacturers who spent hundreds of millions of dollars on R&D activities every year, and who had time and resources to spend on consultants at maybe large CPA firms to help them claim the credit. And to some extent, that's really what was happening. Small and medium-sized businesses we're not really benefiting. But I think the 2015 change in the tax law that we discussed, the eligibility for the payroll credit, has brought a lot more awareness to businesses about the credit. And it has motivated businesses like ours to find ways to make this a more efficient process to claim these credits. Because we're not talking about cases where businesses are claiming hundreds of millions in credits and working with, the large CPA firms. They're smaller businesses where these dollars are still really meaningful to them, but we need to find an efficient way to help them to claim these credits and receive these benefits that they have earned. But even today, we have business owners that might be operating even a small craft brewery or building a seed stage technology startup, and they might assume that they're not investing in qualified R&D activities, but in reality, they probably are. And finally, a lot of SMBs don't pursue the credit because they perceive the process to be too complicated, too costly. They don't have the time for this. And they aren't sure that the benefit of the credit is worth the effort that's required to document their activities, prepare a technical narrative, and submit the filings to the IRS. That's a fair point. I know as small business owners, it's hard to find time to do everything that you need to do to keep the business going. That's obviously the first priority. But I'm hoping as we go through, we're going to talk about specific requirements and details of the credit. You'll be able to think about the work that your company is doing and does this apply to me? Because we can definitely help to minimize the effort that's involved. There is still some work that we need to do together to create documentation and make sure we kind of check all the boxes on eligibility, but we can definitely help to make this an efficient process. So if we're thinking about businesses that qualify for the R&D credit, a lot of times when we're thinking about, if we're talking about a research and development tax credit, we're probably thinking about, that's going to apply to scientists that are working in labs, with test tubes and beakers. Maybe they're developing pharmaceuticals or medical devices. And those businesses absolutely do qualify for the R&D tax credit. That work does qualify. But so do businesses that develop or improve consumer products, cosmetics or apparel, manufacturing lines, businesses developing software. Even if they're not a software-based company, if they're developing software, they may qualify for the R&D credit. If we think about the new recipes created by craft breweries, that is eligible for the R&D credit. It's just a matter of kind of capturing those related expenses, the eligible expenses, and going through a documentation process with them. And it's just the important thing to think about is there's a very broad range of businesses that are eligible for this credit. So we want to kind of keep an open mind when we're thinking about that. Okay, so this next slide kind of gets into the requirements for the R&D credit and how do we determine what is eligible work for the R&D credit and who is eligible to claim it. So when we think about the tax code around the R&D credit, you're going to hear over and over, if you pursue this, the 4-part test. This is the test that's outlined in the tax code, which tells us whether we have qualifying activity for the R&D credit. Qualifying activity needs to meet all 4 parts of this test in order to claim the credit. And the other thing to point out is, I think we touched on kind of before we got started, is the work does need to be done in the US in order to qualify. You need to have activity that meets the requirements, all 4 parts of this test, and related spend, qualifying spend done in the US. And that's going to be the qualifying work and the qualifying expenses for the credit. Sometimes we'll run into a business where a portion of their development activities performed by somebody who is located outside of the US, but there is a portion that's performed inside the US. We would just have to leave the expenses out related to things that are done offshore. So that's just the way to think about that. It may not be entirely no credit, but it would only be related to the portion of the work done in the US. So let's get into the 4-part test a little bit here. The first part talks about the permitted purpose. What this is asking is whether the project or business component you're developing is related to a product, process, software, formula, technique, computer softwares, whether you're developing them new for the very first time. This is the first time your company's creating this product or this technology. or whether you're making improvements on an existing product or technology. Maybe you're creating a new formula. Maybe you have a software that you're adding new functionality to, new capabilities. Maybe there's a new design for a product that allows for a new functionality or performance. It improves the quality. Those types of things are eligible activities for the R&D credit. It is important to remember that it's not just the first time you create something that it's eligible for the credit. The improvements along the way would also be eligible activities for the credit. From here, we want to say, okay, if your company's improving upon, let's say, a software product, they're making a functionality improvement, we need to think about the uncertainty related to that work. What was the uncertainty when you first got started on that improvement? And here we want to think about, how do you describe your, the uncertainty that you had? What were the questions that you were asking when you began this work? I want to make this improvement. I'm not sure if, we are capable of developing this, or are we even capable of accomplishing that work? Or I know I can accomplish that work. I'm just not sure what the design looks like. I'm not sure what the methodology we're going to be using is, or what our approach is going to be. These are the types of things that are technical uncertainties that are, according to the tax code, are kind of meet this part of the eligibility for the R&D tax credit, that second requirement there. Next, we want to document the process that you went through to answer the questions in the last part of the test. So you had some uncertainties. How did you figure those things out? This is really the R&D that we're talking about right here. This is what we want to document. What we want to think about is, what was your process of experimentation? Tell us about the steps that you went through when we're thinking about designing, building, testing, modifying, retesting, that whole process of experimentation. Those are the types of things we want to document here. We want to show that you went through a testing process and what you were solving for. Even details on where you failed, and showing kind of your iterations of development that you went through. That is good documentation to have in your R&D study, and it really helps to support that your business was undertaking the type of activity that is eligible for the credit. You're meeting that process of experimentation. So when we do work on an R&D study with a business, the uncertainty in that process of experimentation, we're going to spend some time on, and we're going to want to get some details documented for that to make sure you've got good, solid support for your credit. And then finally, the work that you're doing needs to be technological in nature. So the work needs to rely on the principles of physical or biological sciences, engineering, or computer science. And that's an important one. If the work that you're doing is more of an operational improvement, and there wasn't like software created or some kind of a piece of technology that was created along with it, then you likely won't meet this part, and that would make you ineligible for the credit. So just kind of at a high level, you want to be thinking about creating something new, making improvements to a product or to a technology, and going through kind of that iterative development process. That's going to be, you're likely going to have your qualifying activity there. All right. So now the important part is, what is this worth? How much can we claim? How much is the credit going to be? And what we want to think about here is, we determined that we have activity that meets that 4-part test. We're able to hit all 4 of those requirements. And now we need to think about, what was the cost of that work? What was the cost of going through a process of experimentation? Really think about that whole process that we described, from designing to building to testing to, kind of modifying, everything leading up to a design or a product that we're then ready to produce commercially or sell to your customer. It's going to be that whole process that we're thinking about for your process of experimentation. And we want to think about, what eligible costs did I have as a part of that process of experimentation? And we really need to tie those things together. If the IRS is going to come back and look at your R&D credit, or they're going to look at this study, they're going to want to see how these costs supported your process of experimentation. That's how those two things were tied together. And so they'll refer to it as the nexus, the connection between your wages, your contracting expenses, your supply costs, and the process of experimentation, kind of your activities that met that 4-part test. So let's look at, oops, sorry, skipped ahead there. So let's look at the wages as the first part here. So when we're thinking about wages, we're looking at US-based employees receiving a W-2. And what we can do is we're going to think about how much time did this individual spend on R&D activities during the year. Let's say we are talking about someone who is more of a, kind of the hands-on person that is doing the actual development work. They could be spending 70, 80% of their time during the year, day to day, on the designing and building and testing, those types of activities. So what we do is we think about what percentage of their time during the year do they spend on these qualifying activities, research, direct support, those types of things. And it would be that percentage of their wages for the year that kind of go into your qualifying pool, your pool of qualifying spend for the R&D credit. Maybe you have somebody who is a supervisor of those activities. They're directly supervising that work being done, and a lower percentage of their time is spent during the year because they have other types of things that they're involved in as well. Maybe it's 20 or 30% of their time. 20 or 30% of their wages are going to go into your pool of qualifying spend for the credit. Let's see. Similar to wages, the same types of activities performed by a contractor are going to be eligible for the credit. So if you pay a contractor to be involved in that process of experimentation, to be involved in those development activities, 65% of the costs that you pay to the contractor are also eligible expenses for the credit. Again, just to reiterate, a lot of times with contractors, we have to ask the question, where was this person physically located when they were doing the work? If they were not located in the US, even if their company is US based, if they're working out of the country, technically those are expenses that do not qualify for the credits. We just want to kind of pay attention to those types of things. And then that last category is supply costs. Qualifying supplies are going to be things that are used up or consumed as a part of the development process. When you think about manufacturing, raw materials going into developing prototypes, going through iterations of prototypes, raw materials that are used up to evaluate machinery and how it's working. Those costs will go in. We can also include some costs like some computer rental costs we can include as well. Computer rentals for this purpose is a very dated term. It goes back to the 1980s when people actually rented computer time. And computers were a very different thing than what I'm looking at on my desk right now. But what today qualifies as kind of computer rental costs is probably going to be like cloud-based storage, AWS expenses, maybe costs to maintain a development environment for a software developer. Those would be eligible expenses. When we get into supplies, we are not able to include things like capital assets, machinery, and equipment. Those costs we're not able to include. Sometimes we'll get questions about utilities or travel costs. Those types of things aren't going to get us there. It's really things that are kind of used up or consumed as a part of your development process. And then once we have looked at expenses in these categories, we've documented our 4-part test. We're going to document how these costs are a part of that 4-part test, how the individual was involved, how the supplies were used in our process of experimentation. And then we've got kind of our pool of expenses here. We're going to go through a calculation under 2 different methods to find the best benefit available to your company. But as a general rule of thumb, about 7 to 10% of that qualifying spend is where the credit typically lands. All right, so we've gone through qualifying activity for the credit, qualifying expenses. So now how do we actually, we say we've calculated your credit, we've done all the work. How do we actually get the money, right? Is obviously key to this whole process. And what we want to think about here is the last 2 slides we went through with all those requirements, those apply regardless of whether you are claiming an income tax credit or a payroll credit. Those apply either way. You have the same qualification, the same eligible expenses and things like that. So those apply either way. When we're thinking about an income tax credit or electing a payroll tax credit, that's just really how your credit is going to be used, which types of expenses or which types of taxes you're going to use those credits to offset. So let's think about the payroll credit for a minute. when you make the election, you have to be a qualifying small business. You make the election to use the credit against payroll taxes. In this case, the business has to be a qualifying small business that meets what we call the 555 test. This is a company that has less than 5 million in gross receipts in the credit year. They're within their first 5 years of receiving any gross receipts. And they cannot take that credit. They cannot make that election to use the credit against payroll taxes for more than 5 years on 5 tax returns. And so this is really something that is aimed at startup companies. Additionally, the election to use the credit against payroll taxes needs to be made on an original timely filed return. You're not permitted to make that election on an amended return. So that's something important to think about if the payroll credit is an option that makes sense for you. And another thing to note is for the purposes of kind of thinking about that first 5 years of gross receipts, the IRS's definition of gross receipts there is actually pretty broad. So when we think about gross receipts, we are not only looking at like the sales, the revenue of the company, we're looking at things like interest and dividends. Those types of income also impact when the gross receipts kind of clock starts ticking here for this purpose. Let's see. So for a qualifying small business, the payroll election is made in Section D of the Form 6765. It's also the same form that is used whether it's an income or a payroll credit. There's just a different section to be completed if we're making that election. And then the credit is utilized to offset the employer's portion of FICA tax on payroll tax returns. Those are typically going to be filed by your payroll tax company, or maybe use a PEO organization, whoever's filing payroll returns and managing that for you. They would need your credit information, and then they can apply those credits on your quarterly. It's Form 941 for the payroll tax return that is filed on a quarterly basis. They can use that credit each quarter, does carry over if your credit is in excess of the eligible tax, to continue reducing your payroll tax liability until it's used up. Now, when we're thinking about using the R&D credit against an income tax liability, you don't have all these restrictions like you do with the payroll credit. It's not as limited. Early stage companies, late stage companies, no matter how many years you've had gross receipts, no matter how large your credit is, there's no limit. There are not the same limits on an income tax credit like there are in a payroll credit. You can claim an income tax credit every year. It doesn't matter how large your gross receipts are. Your credit is not limited to any kind of a cap or anything like that. And when you're claiming your credit against income tax liability, you are just reducing your business, the liability on your business income tax return. You go to file your tax return and pay your taxes for that year, the taxes are going to be reduced by your credit. And like we said, if the credit amount is larger than what the liability on the return is, the balance of that credit can carry forward for up to 20 years. So you've got a good long kind of runway to be able to use that credit before it expires unused or anything like that. Oh, and the other thing on the income tax credit is you are allowed to claim an income tax credit on an amended tax return. So if we're having this conversation now and you're thinking, well, I could use this next year, but last year, and I already filed that tax return, we really had a lot of R&D spend. This would have been helpful for me to know a little bit more about that time. You can go back for about 3 years and amend your tax return and claim an income tax credit. So keep in mind that that is an option that's available as well. So now we talk about defensibility. Another question that we get often from businesses that are going to claim a credit is they're thinking, if I claim a credit, is the IRS going to then come and audit me? Is it going to be kind of a cause and effect? Because if I'm going to turn around and get audited by the IRS, I definitely don't want to, kind of go down this path. I got to decide whether it's worth it. I will say that we see no direct connection between claiming an R&D credit and the IRS coming to audit. We've had a very small percentage of our clients that have ever been audited by a state or the IRS. It's just not that common, and we're certainly not seeing any cause and effect relationship with claiming an R&D credit. That said, when we are working on your R&D study, and we're asking you questions trying to create this documentation of your 4-part tests and how the expenses, supported those activities, we're documenting everything as if the IRS might look at it, just in case. We want you to be in a good position that you have good, solid documentation supporting any credits that you've claimed. And so here's where we're talking a little bit about defensibility and what is included in that study report. In an audit situation, the IRS will be looking at certain aspects of the credit to make sure it was claimed correctly. In the reports that we create at the end of a study, the sections that are commonly evaluated in an audit are identified, and they're kind of easy to locate. If you end up in this situation, well, we want to make it as easy as possible for the auditor to see, okay, they did these things, and now I can move on, hopefully. Our software application was actually built based on the requirements in the published IRS Audit Techniques Guide for the research credit. And so we're really kind of aiming to answer any questions an auditor might have, or as many of them as we possibly can up front with our report. So within the reports that are provided at the conclusion of a study, we're going to give you, we're going to make sure that is included a clearly defined business component. That's going to be your business component is the focus of your development work, your product or what you're focused on developing. It's going to be found in the innovation section. Documentation of qualified activities, meeting that 4-part test, are going to be captured in the qualification section of the same study report. Your qualified expenses and a discussion of how those expenses were incurred as a part of your process of experimentation are going to be included in the calculation detail report. And then the credit calculation under each available method is going to be captured in the calculation portion of the study report. Our platform has been built to assist you in highlighting and discussing the work that qualifies. And our team of R&D tax experts are available to assist throughout the process. We work with you to ensure that the final study documentation meets the requirements in the tax code around eligible activities, qualifying development costs, and available calculation methods. We want you to have confidence in claiming a credit and claiming the maximum credit that you're entitled to, knowing that you have the support behind it to back it up should there ever be a question. And then just to touch on our software a little bit here at the end, Arbo Claris R&D provides a software-assisted solution, is what we provide. And it's intended to guide you through the documentation process to make that a little less painful, to have support, answers to questions, some guidance in there, to allow you to kind of work through a portion of this on your own without needing to schedule multiple meetings in an already busy schedule that I know a lot of you have. And it really provides, it's really intended to provide the highest level of accuracy in documenting your credit while creating a very straightforward and what is easily repeatable process to claim this credit year after year. We're all about making this an efficient process for you. For the preparation of the credit, our software is paired with a team of R&D experts, and that's the team that I work with. We've got tax experts and CPAs who ensure compliance while still simplifying the process. Our software encompasses a comprehensive approach to collecting information for the study process. But our team is always there to provide support. You can actually contact us directly from the software. We go do an overview and an onboarding call when we first start working with you, and we go through the responses and we make sure kind of the documentation is all buttoned up before we deliver a study at the end. Our software is equipped with features like directly connecting to your payroll or PEO provider, allowing you to import employees and wage information so they don't have to manually enter those things. We have time surveys to ensure that contractor time allocations, employee allocations are correct. And we also have recently incorporated AI support. And what that does is that helps with documentation by kind of making suggestions based on the information that you've entered, helping you to think about that process of experimentation, helping you to think about the uncertainty that you might have experienced in your development process. It's not answering it for you. We need the details that only the person that is kind of there with the business can answer, but it definitely gives you some guidance and gives you an idea of how much detail to provide. And then our team of experts are always available to hop on a call for complex situations if you've dealt with controlled groups or grant funding, or maybe we just need a refresher on some questions that we might have covered earlier. We are always available to kind of help with those types of things as well. At the end of the study, we're going to provide documents and a study that demonstrates the nexus between your qualified activities and expenses, and it shows your calculation. We'll provide you with your Form 6765. That's the the research credit form that needs to be filed with your business income tax return. So that's something that you would hand over to your CPA or your tax preparer to file for you. And then you can monetize the credit in kind of one of those two ways that we spoke about earlier, whether you're doing it against your payroll taxes or your income tax liability. And we can work through, any questions you might have, or if your CPA or tax preparer has questions as they're including your credit information in your tax return, we are happy to assist with those as well. And I think that's everything I had in my presentation. I don't know if there are some other questions we can answer at this time. I think we have a little time left, so I am happy to answer some questions. If there's anything you want to pop in or jump off mute, I'm happy to go through that, and Sybil could answer some questions as well as it relates to kind of how we arrange contracts and things.
Okay, so I've got a couple for you.
Okay.
Most of our inventors do not have employees.
Right.
The most likely the only employee they're ever going to have is possibly themselves.
Okay.
Does it make a difference whether or not they set up their company that they are an employee, they're paying themselves, or are they better off taking that as rather than as a payroll tax and income tax?
So if we're talking about paying themselves for the sheer purpose of being able to utilize a payroll credit, I don't know that that makes a lot of sense. You want to make those kinds of decisions because that's what makes the most sense for the business from an overall business perspective. And what we need to think about is when we're thinking about the payroll tax that you are able to use your credit against, we're looking at, a very small percentage. We're looking at about, 10, 11% of the pay on a quarterly basis that you'd be able to utilize of that credit. Yeah. One thing you do have to be cautious about when you make the election to use the credit against payroll taxes, it is a payroll credit. You can't recategorize that as an income tax credit. And so if you've got this great big credit and you're chipping away $1,000 or $2,000 on a quarterly basis, it's going to take you forever to be able to realize that benefit. You might be better off with an income tax credit in that case.
And I think the big thing with inventors is that if they know how to use this sooner rather than later, they can structure their business for it. They can, most of them, like Sarah, is going through a lot of development with Noah McNeely, here, feet on the ground in the States. But there's a good chance, that her manufacturing, all right, not the development and the design work and the research and everything, but the manufacturing will be done in China. It'll be shipped to the US or someplace else. Who knows about China these days? But, made in America, we're seeing a lot of that come back now. We've got little plants that are starting to, pop up all over the place. But, let's assume that, we get back to a sense of status quo and manufacturing is done in another country and then brought over and then sold here in the US. But all of her development, all the research, ongoing development, making a better product is still done here in the US. Does she take then?
Yeah. So what we would want to do is we'd want to think about, okay, so who's involved in the process? Who's involved in the work you're doing here in the US? What are you doing here in the US? We're talking about designing. Are we talking about, building prototypes and testing those and going through some iterations there? So we get to the design that we then want to send overseas to be mass produced, our specific design. Maybe they do some certain amount of additional testing overseas. Maybe they do make some tweaks or adjustments. I don't know if that's the case, or you send them, this is what we want built, go ahead and make however many of them and send them back to me. You're doing the R&D here. You're doing that here in the US. What they're doing is the commercial production. That is not eligible for the credit. And so the work here in the US, you would want to think about, again, am I using contractors? Do I have materials and supplies that I'm using for that testing process and building those prototypes and testing and modifying those prototypes? Those are going to be your eligible expenses here in the US.
So that's, and most of the inventors, that's what they do.
Okay.
They do their development, their research, their development is all done, feet on the ground in the US. What a manufacturer would do in another country is now the manufacturer's prototype. So there may be some tweaks to it or whatever, just so that, you can, make it maybe at a reduced cost if they were, a half inch shorter. And so that's kind of what we look at for the majority of our inventors is that early stage, they're hiring contractors, They're doing all their development here in the US, but they may not have any income from it until they get it back here to the States and they're able to sell and have then the income to use against the credit.
Right. Right. That makes sense. And just as a general rule of thumb, because I know as you're getting started and you're like, I don't have any income yet. I've generated these losses. I've got these accumulated losses. Those losses have to be used before you can use the credit. We want to work with somebody where it makes sense. But as a good rule of thumb, we always kind of say, if you see yourself burning through those losses in the next 5 years, and you're looking at projections and you see that you're potentially going to be paying income taxes in the next 5 years, it makes sense to start accumulating these credits. And then you've got them you've got that stack of credits sitting there waiting for you. Once you burn through those losses, then you can start using the credits to offset the income tax and hopefully not to pay taxes for a little bit longer.
Yeah, Sarah.
Yeah, thank you. It's super interesting. I wonder a couple of things. First, I'm in Washington.
Okay.
So that was one of the states that wasn't on the map.
Mm-hmm.
So we don't have state income tax.
Right.
So maybe do you want to answer that one first, and then I'll answer this one?
So I think what you might be thinking of is because they don't have a state income tax, they weren't on that map. That map, and I probably didn't explain it clearly enough, that map was only relating to which states offer a state credit. You don't have any state income tax liability. You don't need a state credit, so you don't have either of them there. The federal credit still, you still have federal income tax liability once, you start having profit and you're going to start incurring some income tax at a federal level with the IRS filing. So when you file with the IRS, you're going to have that, and that's where those credits, the federal level credit would be used.
So, maybe I'm talking about somebody else, maybe not myself, but what if I have back taxes to file? You know what I mean? And there's been a lot of research and development, not only on my patent and the engineering of my really cool, innovative tool, but also on the bad advice that I get in business from half of the people. So to me, that's research and development, all these extra costs that I'm paying for these business licenses that I didn't need because somebody told me to get it.
I did not do that.
Just to be clear, right?
I'm not saying any. No. I'm just saying hypothetically.
I know. It's no, don't do that. Don't do that.
Hypothetically, whoever is in that position, that is unfortunate. And it is unfortunate when you get bad advice and you find yourself spending money that you didn't have to spend, certainly not on things you didn't need. And that's unfortunate. When we talk about one thing, I was just about to point out, when we're talking about, I think one thing that can be a little bit confusing, we're talking about research and development here. What we're really talking about is your development process and building your product and going through iterations of development of your product and testing different materials, different designs, those types of things. Research, when you are researching something for your business, even opening a book and researching something, that is not time for the credit, unfortunately. Remember, everything kind of ties back to that process of experimentation and the development of your product, or, if it's a software platform, it's a product, it's something like that. That's what's going to qualify. It has to be tied to that product and that process of experimentation that you're going through. Unfortunately, somebody should be paying whoever this hypothetical individual is back for all the time that they wasted and the money that they spent unnecessarily. I think that's only fair, but unfortunately, we can't get there with this.
No, that's pretty much not going to happen. But anyway, sorry, Sarah, on that one. But okay, so I've got a very, you kind of hit on a few words there, and I do not try to get into your sandbox, ladies. I know just enough about this to say, yep, get on their website, because I can't do that.
Right.
But the one question I get frequently is when the inventor is first starting, their first, they go out, they do their own looking around, but their first research, all right, is generally a product and patent search. Should they move on? Now, I have told them filing the patent is not covered. All right, that's kind of opening the book. That's not covered. But that first phase of getting the search done, that is the research. Would that be covered?
If you could somehow tie that back to creating your design, something that is market research will not qualify. So market, when you get into the R&D tax credit in our software, there's a list of things, and it's in the tax code, of excluded activities, things that are kind of those gray areas, and you're like, not sure if this works or not. Is that close enough? Market research is something that does not work.
Right.
They'll call it re-engineering an existing product. Like if you take this product and you are just kind of copying the same thing, that's not going to work. But if you think about it, those aren't things that are taking you through a process of experimentation. You're not designing and testing and trying to solve for an unknown. If you somehow could tie that to a design, like a design you were creating, you might get there, but I think that's going to be a little bit tougher. I think what you're describing sounds a little bit like market research and kind of trying to see what's out there and what are we going to do that's different. I think that's more kind of your background information. It's tied directly to kind of this product that you're developing is kind of the qualifying time.
Yeah, I mean, they're looking at what is out there that they can look at, saying, all right, this is my idea, but I need to know what else is out there to know if what I've got is new and novel.
Yeah, that time is not going to get you there.
Okay.
That's going to be treated more like market research. It might inform what you do think you can move forward with and say, okay, I know this is there. This is what I'm going to do. And so I'm going to put this down on paper. Once you start putting down on paper your design, start working with that, then I think you've got qualifying time.
Okay. All right. So, but if you're doing it, then no, because you're just taking the research that was handed to you and going through on your own time and looking at it. So there's not generally then, and so the patent attorney wouldn't count. Right. Because he's looking at writing the patent and that's not covered. But then like when Sarah uses Noah, who is the product developer, and she said, okay, Noah, look at these 3 products and these 3 patents and tell me what I can develop.
Mm-hmm. Yeah, those things aren't going to get you there. You got to say, this is my design and kind of start going through those iterations. I mean, it might inform what you do with your design. But once you kind of get your design and what you're going to do down on paper, that's the time that's clearly. The other is very gray and market. If it's something that could be viewed as market research, trying to see what's out there. That's something that's kind of specifically listed as an excluded activity. I would steer away from it just because if you get audited, they're going to say, nope, taking that part out. So
yeah. Russell, go ahead. You're muted. There you go.
Yeah, so if I'm working on a prototype, I'm using materials.
Yep.
And I'm taking time. So I'm billing for parts and labor, basically. And how much per hour am I allowed to bill for my time?
Your time, it would be whatever you are paid. It would be the time that you're paid. If you're not taking compensation, then you're not going to have something to value. It's generally going to be box 1 W-2 wages, because we can say this is an established value for this time, and 10% of their time or 50% of their time was spent on R&D, and I can explain that. 50% of that wage, that's what the cost is to the company for that R&D activity.
So what about materials? I use tape, I use glue, but I don't use the whole bottle of glue. I use some undetermined amount of glue. How do I tell them how much glue I'm using and what it costs?
I'll make another one, Russell, and the glue.
I mean, it's just all these vagaries that make it.
You just try to use some kind of any reasonable estimates is fine. You can come up with a reasonable estimate of what you're doing, and then you can kind of pool those costs.
All right, Mike, you've got a question, and Mike is our Canadian attendee for tonight, so totally different view of kind of R&D. So go ahead, Mike.
Oh yeah, so I just remember before we started, Rita, you prompted me to remind you.
Oh yes.
Question.
Yeah.
So
and
that as well. Yes.
Even if he's made. All right. So my question: if he's selling the product in the U.S., but he is a Canadian citizen, he's not paying any U.S. taxes. Is that correct? So he would not qualify. He's got to be a U.S. citizen paying U.S. taxes to qualify.
So you can go a couple different directions there. Does he have a business entity in the U.S. that is paying taxes? But if the development activity isn't happening in the U.S., you can't get a credit in the U.S. You're selling into the U.S.
Okay.
That would certainly generate income for your business. But if the development activity is not happening in the US, that's not going to, you wouldn't be eligible for a US based credit. And then as far as a tax liability, is there a business entity in the US that does have a tax liability that could potentially use a credit? But I don't think there would be a qualifying credit here in this case.
Very good. Yeah, this is a great source of education. I do have, I guess, the patent attorney that I've been using, Andrew, a guy I've known for a couple of years. So he lives in New York, but I was advised, and many people going back a couple of years always said, you have to sell something in America. You're gonna, the Canadian taxes also are a nightmare. Never mind. There's an election tonight. Hopefully we'll get rid of
there is.
we'll get a Trump-like person also, but the 51st state.
Good luck to you.
Research and development that Mike is doing on his product is pretty much in his, his own office lab. He's doing software. So it's a program, an algorithm, and so a little bit different than Russell or Sarah, who are making a product, textile product.
Yep.
Feely, worky thing.
Yep. Yeah.
Correct. Yeah. In a few words, I'm a techie. So anything that looks like holding your hands is just part of the text. So not a no product here.
We do lots and lots of software credits. So
but I think my point is that he's not using an outside developer that's got he's his own developer, so it makes it a little more challenging.
Right.
Anyway, I know that folks are going to have more questions for you. Does anybody else have a question tonight? All right, Russell, you got another question? Go. Russell, unmute yourself.
You said 20-year period, so that if I'm operating, breaking even, or at a loss now, I keep track of my expenses. But when you say 20 years first, starting from when?
So if we say that in, let's say right now you're getting ready to file your 2024 tax return because you filed an extension and all that, so you didn't have to file by April 15th. You're about to file your 2024 business income tax return, and you're going to claim an R&D credit on there because you had activity and expenses in 2024 that qualified. We calculate your credit. We're going to put it on your 2024 tax return that you're filing tomorrow. So this is April 2025. You got till April of 2045 to go through that many more tax returns that might have some liability on there that you could use a part of that credit towards. And on your income tax return, if you claim those credits each year and you've got 5 years worth of them that are stacked up and sitting there on your income tax return, there is generally going to be, most tax software has a statement that is attached to the back of your tax return. It's going to list out each of those credits. In 2024, you had a $20,000 credit. In 2025, you had a $30,000 credit. It's going to have them all sitting there, and they'll chip away at that earliest one first. So you use up your oldest one first, because that's the one that's at risk of expiring technically, and then you would move on to the more recent ones.
So do I need your help or software to do that?
Of course, you need our help to claim an R&D credit.
Why do you think you're here? Yeah.
How do you charge? How do you charge?
That's civil suit.
I mean, how does that work?
Yeah, we charge a success fee. So depending on your credit size, we charge between 8 and 20% of the credit. As your credit grows larger, our tier works down towards that 8%. And jumping on a sales call, I know it was in the slide deck with that QR code, and I'm sure Rita will send it out after too, but you can jump on a sales call with someone from our sales team. They can walk through your eligibility, kind of those expenses, those 3 buckets that we talked about that the calculation is going to be based off of. They can give you a rough estimate as well as roughly kind of what our fee would look like depending on what that tier that you would be in price-wise.
Righty.
I have sent out that QR code, Russell. You should have it, but I can send it out again. I've got a flyer that I've sent out.
Awesome.
Okay. All right, guys, good job. Thank you, Monica. Thank you, Sybil. I know that I've sent out Sybil's email address, posted it every place so that if anybody's got any specific questions, and believe me, I do tell them I learn a little bit more every time and a little bit more that say, don't get in that sandbox, Rita. You know better than that. All right, you guys, thank you so much. This is a big deal for inventors, and it's a big deal for early stage inventors to know, when they get teed up, how to be able to use this. It's a great tool. So thank you, ladies, very much. We appreciate it.
Thank you so much for having us.
Have a good night.
Thank you.
Thank you.
Good night, everybody.
Good night.
Right.